Hello and welcome back to my channel. This video is about principles of bookkeeping controls, and today I'm going to talk about bank reconciliations. This topic includes different payment methods, but I won't be discussing about them because they are self-explanatory. So it would be better to finish those topics in your textbooks first and then move on to the bank reconciliation process. First, what is bank reconciliation? It is a process that should be done regularly to make sure that the balance of the bank and the cash book agree. And we prepare a bank reconciliation statement that shows the reason why if the bank and the cash book don't agree. Now let's go to our example. The bank statement and cash book of ABC Limited are shown below. So this is the bank statement of ABC Limited for the month of May and cash book for the month of May. And we can see that the ending balances do not agree, and we will find out why. In doing the bank reconciliation, we will follow 4 steps. Step 1, match and tick off all the transactions. Step 2, match and tick off the beginning balances. Step 3, update the cash book and calculate the closing balance. Step 4, prepare bank reconciliation statement. Please take note that usually in your textbooks, step 1 is to match and tick off the beginning balances first, and then step 2 is to match and tick off the transactions. You can follow either way, it's just for me. Personally, I prefer to tick off the transactions first, and I will tell you why later. Before we start with the step 1, please take note as well that in the bank statement, the debit and credit is the complete opposite of the cash book. Credit means money in and debit means money out. And what you can see here beside the balance, the C means credit balance or positive balance. If you see D, it means debit balance or negative balance or overdrawn. To help me remember, I usually associate the letter D, that means debit, to the word drawn or overdrawn. In some cases, in the bank statement, it says money in or money out, which is much easier. But just in case you see debit and credit, remember that it's the opposite of the cash book. The reason why is because this bank statement is issued by the bank with these informations based on the bank's perspective. So to them, if you deposit money or receive money in your bank, it's credit to them because that money is not theirs. It's their liability to you as a bank account holder. That's why it is in credit. And if you draw money or spend money, it's debit to them because their liability to you as a bank account holder decreases. One more thing to take note is that the closing balances of the bank statement and the cash book are not always equal. Now let's follow the steps. Step 1, match and tick off all the transactions. So let's just match the debit here to the credit in the cash book and tick off or mark them. Let's compare the amounts and the dates. The dates doesn't have to be an exact match as long as it's not a very huge gap. So let's just match and mark them off. Now let's match the credits in the bank statement to the debit of the cash book. Once done, let's go to step 2, match and tick off the beginning balances. We can see that the beginning balances are not equal, and this is the reason why I prefer to match it off after all the transactions. It's because we can easily see the remaining ones that has no match. These two have no match, so we can do a trial and error by adding or deducting them to the opening balance. So the opening balance is 8,946. This one is in debit, so we will deduct 1,684. And we can see that the total is still not equal to the opening balance of the cashback. So let's try to add 968, which is in credit. And we can now see that the balances are equal. We can now tick off this three in the bank statement because they match off the opening balance of the cashback. Now let's go to step 3, update the cashback and calculate the closing balance. The remaining transactions in the bank statement that is not ticked off means they are not yet in the cashback, but they are cash transactions, so we should add them to the cashback. The first one is this one, a door. It's in debit, so we should add it in the cashback in credit. Next one is D and Company in debit, so we should add it in the cashback in credit. And the last one is this one, bank charges. It's in debit, so we should add it in the cashback in credit. So these three in the bank statement match off these three in the cashback, so let's tick them off. Now everything in our bank statement is ticked off. We can now recalculate the closing balance. So now our new closing balance is 10,234. Now let's go to the last step. Step 4, prepare bank reconciliation statement. So this is the usual format. Let's enter the balance for bank. We can see outstanding lodgements and unpresented checks here. Let's find out what are the meaning of these two. These are applicable for checks as the payment method. First, outstanding lodgement are checks received and paid into the bank but have yet appeared on the bank statement due to time lag of clearing. So it's a check that we received as payment from our customers. We recorded it to our cashback. We paid it to our bank, but it won't appear in our bank statement as the same date that we have paid it to the bank because of the clearing time. Second, unpresented checks. These are checks issued but have not yet appeared in the bank either because it has not paid into the bank yet or it is still in the clearing system. So it's a check that we have issued and sent as payment to our suppliers. We recorded it to our cashback, but we don't know whether our suppliers paid it to their bank already, or if they did, it won't appear in our bank statement as the same date that it was paid to their bank, again because of the clearing time. Now let's go back to our cashback. These two remaining transactions in debit are outstanding lodgement, wherein we received these checks from our customers, paid it to the bank, but we cannot see it yet in our bank statement. And these two remaining transactions in credit are unpresented checks wherein we issued and sent these checks to our suppliers, but they are either not paid yet to their bank or already paid, but we cannot see it yet in our bank statement. That's what happened in our opening balances here, wherein these two were recorded in the previous month cash book, and that time it hasn't appeared in the bank yet. So we have to remember that outstanding lodgements are the checks we received and unpresented checks are the checks we sent. Now let's enter them to our reconciliation statement. Then let's calculate the balance per cashback. The outstanding lodgements should be added and unpresented checks should be deducted. You may see the add and less in your assessment, but still, it is important to know whether they are deducted or added, just in case it is not indicated. So the balance per cashback in our reconciliation statement should be equal to the adjusted balance of our cashback. And that's it for today's video. For the next video, we will answer some practice assessments. So if you want to watch more videos like this, please don't forget to give us a thumbs up and subscribe to our channel. Thank you for watching.